President Baca, Vice President Baum, Chancellor Harris, members of the board, good morning. As you know, later this week, the governor will introduce his proposal for the budget for the 13-14 fiscal year. And that tends to create a one-year scramble where we look at just that one-year budget, trying to get our priorities fixed into the language for that year. I think prior to taking that kind of short-term perspective, it's helpful for the board and for the our community to take a broader look at the economic conditions over the next few years so that we can consider our priorities and how the ongoing Prop 98 revenues are likely to support a sustainable budget goals for our system. Annually, each November, the Legislative Analyst Office releases a 5-year fiscal forecast that does just that. It takes a look at the broader economic trends, what that is likely to mean for our revenue picture over the next few years, and for of most interest to community colleges, the Proposition 98 revenues as well. With that, I'd like to introduce Mac Taylor. Mac is the 5th, I believe, legislative analyst in our state's history. He's had that title since October of 2008. And the report that came out in November, I think, generally has pretty good news for education and for the community colleges, thanks to Proposition 30. And without further ado, I'll hand it over to Mac for his presentation today. Welcome.
Thank you, Dan. Mr. Chairman, members, it's a pleasure to come before you today and chat with you for a few minutes about our document. We put it out in November, as Dan said. And what I've done is taken some key charts from that document. I thought it'd be a little easier for you as we flip through. And I'd just like to go through and kind of tell you kind of where we've been and sets up where we may be going in the next few years. I like presenting to small groups like this because we can have more of a conversation. I would welcome, as we go along, your questions, your interruptions, your comments, your dissenting views. So please just jump in if you have things that you'd like to chat about as we go along. I think it'd be much more fun for all of us. Starting on page 1, this chart to me says a lot about why we've been in such problems over the last 4 years. It's a little bit complicated, but it has 2 stories. And what it shows is our job losses in this recession and the past recession. And if you look at the dark blue line at the bottom, those represent the job losses from the current recession as compared with the prior ones. And you see going down the page, that's the percentage of our workforce that we lost in the recession. And you can see it was about 9% of all jobs. And that's about 2 or 3 times as much as in the prior 3 recessions. That tells you how deep the recession's effect was on California. Now, going across the page, that tells you how many years we project it will take before the level of jobs returns to its pre-recession peak. That is, when do we get back to where we were before all of this mess started? And you can see for past recessions, it was 2, 3, 4, 5 years. This one, we're projecting 7.5 years. That'll be in probably the end of 2015. We will finally recover those job losses. So again, it just tells you the impact of the recession on our economy, why we lost so much of our revenue, and why it's taking us so long to get back into sort of a fiscally stable situation. If you turn to the next page, I'm sorry, this is a mass of numbers, but I want to focus on just a couple of things. These are our forecasts for general fund revenues, not the special funds and everything else, but what really affects your budget for the most part. How much general fund revenues do we have? And I really want to point out 2 things, and one is not real obvious. You have to kind of take the top line, personal income taxes, and compare it with the bottom line, total revenues and transfers. But if you were to do those calculations, you would see that it's almost 2/3 of our revenue is coming from the personal income tax. Now, the implications of that will become more obvious once we get to the next page. But let me just note that with the passage of Prop 30, we've become more dependent on personal income taxes. The other thing I want to point out, and again, it's not real obvious because we didn't have the change numbers, but if you looked at that bottom line of how revenues are growing, we're forecasting that they're going to grow about 6% a year, which is kind of a historical average. Revenues tend to grow roughly with personal income, and over a long period of time, a business cycle, say, you would expect revenues to grow about that much. But keep that figure in mind when we compare our forecast for expenditures. Okay, so keep those two things in mind. Now let's go to the next page. These are capital gains, both historical and projected. Capital gains, or net capital gains, are basically when people sell property, they sell their stocks, they realize an increase in the value of those gains. And they're important because they're a much more dominant part of our total personal income taxes we get from capital gains. And of course, property gains from property sales when we have our housing bubbles are also very prominent. But I just want you to look, in the early 90s, do you see where capital gains were roughly in the $20 billion range? And look what happened in the year 2000.
Wow.
Six-fold increase. That was the dot-com boom. And then look, 2 years later, they're back down closer to the historical levels. That's the dot-com bust. And remember, these are gains that are typically paid by high-income people, so they're at the highest tax bracket. So you're getting almost a tenth of tax revenues for this amount. Every $10 billion in capital gains gets you almost $1 billion in revenues. So when these go up and down like this is much of the cause of our budgetary volatility, capital gains. And you can see they went back up to the kind of dot-com levels in the mid part of the decade, and then they fell once again back down in 2009 to 29 billion. This is the roller coaster that we've been on the last 10 to 12 years. And Proposition 30, again, by adding those top marginal tax brackets, you now have people paying 13.3%. And the very wealthy, of course, is where you have most of your flexibility and volatility because they have much more control over how they do their taxes. So we have a very volatile revenue structure. We had it before Prop 30. Prop 30 made it a little bit more volatile. But what that means is that when we talk about our forecast, and I get to some numbers a little later on, we typically will forecast a more stable growth pattern for revenues. As you saw in that prior chart, they tend to grow 5, 6, 7% a year. That's not the way it will happen. What will happen is you'll get some spikes, and when that happens, it's very good for Prop 98 because it tags along with the growth in general fund revenues. And then you'll get sharp declines. And then you have to deal with test 3 years and deferrals and all sorts of things because we have to somehow make our budget balance. So one part of the problem of doing fiscal forecast is that nobody can call those ups and downs very well. Certainly we can, and I don't know of any economic forecaster who can. So even though we forecast rather stable growth, that's not what you're going to experience. And it has implications for you as a board on how you think about your budget. It certainly has implication for the legislature and me as an advisor to them on how they should deal with that volatility. The single best thing that they can do, in my view, is have a very large reserve. Now, you can imagine, though, the forces that work on the legislature as we get more money, if we continue to grow and we don't have problems with the economy, we don't have a downturn, we don't hit the fiscal cliff, do you think people are going to want to sock money away in the reserve? Or are they going to want to try to restore some of the cuts that have been made over the last 4 years? And so I think you just need to appreciate the pressure that's on the legislature on those kind of demands that will be made on them and what they need to do to prepare themselves for the next time that revenues turn south. Let's go to the next page. These were our forecasts for the various expenditure programs. Again, they're not our predictions of what we think of what will actually happen. It takes current practices, what's now our commitments that are in place, and what would happen if you just played those out over the next 5 years. And let me just make 2 points from this. Go to the bottom of the page, the very lower right corner. And this is the annual average growth that we're forecasting for expenditures for the next 5 years. And you see it's 3.6%. Well, that's not very much. And one reason for that is because there's a lot of areas in both universities, judiciary, where we forecast basically no growth over the entire period. And why did we do that? Well, the legislature in statute has a practice for not having automatic adjustments to university judiciary, other state operations. Doesn't mean that they won't give inflation adjustments, but we kind of went off that statutory language that not to plug in inflation adjustments. For the universities, the other main driver is what's happening in your college age education cohort, your college going group. It's not growing over the next 4 years. In fact, it's going to be declining at the end of our forecast period. Now, do we think then that there's not going to be any growth in the university's budgets? Well, no, that's not a prediction of what will happen. It's just that's the basis for our forecast. But anyway, so you have 3.6% annual growth. Well, remember what our revenue number growing was? It was 6% a year. So that will be obvious when we get to the next page. The other thing I want to focus on, since obviously this is the community colleges, is the top line, our Prop 98 forecast. And you see it growing 3.9%. Now that is not the 98, that's the general fund share of 98. And so you obviously should be more concerned with the total, including property taxes. But for our forecast purposes, this is just the general fund share, and you can see it's growing almost 4% a year. Let's turn now to the next page. So putting those two numbers together for the average annual growth rate for revenues and for spending, and obviously, if that's true and your budget starts roughly in balance, you're going to have growing surpluses because revenues are growing faster than expenditures. Now, we start in 13-14. We forecast a very small deficit, about $2 billion. That turns into a very small surplus in 14-15. So I think roughly the way to think about it, for the next 2 years, we're kind of just in balance, just barely in balance. Not a lot of surplus or anything. And what that suggests to me is that you can continue to fund what you've been funding, but you can't do too much more. And if you want to do more, you have to cut something else. You either have to, if you want to over-appropriate 98, you have to cut something else. If you want to restore some health and social services that have been reduced, you have to cut something else. Or you have to add additional revenues on top of what was added under Prop 30. So kind of, I think about it in the next 2-3 years, pretty much tight budgets. Now, 98 is different, of course, because we have built into our projections what 98 will grow by under the Constitution. So we'll get to 98 in just a second. But for the rest of the budget, it's kind of like a baseline sort of spending levels. Those surpluses do grow, though. And they get up to $9 billion if you just continue to do exactly what you're doing now. Again, we're not predicting that will happen. And there, for a lot of other reasons, we think you should be cautious about what those out-year surpluses mean. But these are just the numbers. It's interesting, all of the sort of motives and intent that people have ascribed to us in putting out these numbers. They're just the numbers. And what you do with them, obviously, is up to the legislature. Now, the next page is probably the most interesting in a way, because right after we put out those numbers, we gave all sorts of caveats as to why you needed to be careful. And I do want to spend some time on these, because there are a lot of very important caveats. The first and foremost are risks to the revenue forecast. Now, we put out the November report before action at the federal level on the fiscal cliff. We didn't go over the first part of the fiscal cliff because they extended most of the tax cuts. We still have important aspects of that cliff in 2 months from now when they'll have to deal with the sequestration and the debt ceiling. So we're not past those kind of risks to the forecast that could be very severe. And should there not be a resolution, should there be a slowdown in the economy, the numbers from the prior page you can just throw away, because we'll be in a very different situation. Obviously, even independent of the fiscal cliff, you always have lots of ups and downs and uncertainty regarding our revenue forecast. I don't know of a time in my stint in the office where there's been as great as uncertainty over how to do revenue forecasting as there is currently. Wow. We have made changes to our revenue structure. We've made changes to the way individuals pay their taxes. We have talk about tax increases at the federal level, which affects people's behavior on whether they're going to whether they accelerated payments from January into December. Right now, revenues looked very good for December. Was that just because people, in anticipation of higher federal tax rates, moved income from 2013 back into 2012? Likely that's true. So if you were to see good news about, what the revenues are really coming in, Again, you should have great caution about that. It may just mean that all we're doing is moving money that would have been realized by the state in 13-14, and we're accelerating it in 12-13. We may seem like we're better off now, and we could be worse off in the future. So very difficult times for forecasters given all of the changes we made in our tax structure and because of all the uncertainty at both the state and the federal level over tax policy. The forecast assumed no transfers to the reserve. Some of you will remember back in 2004, we actually passed Proposition 58, which requires us to set aside 3% of revenues every year unless the governor waives that or suspends that transfer. So if we were to do those transfers, which we should be doing as soon as our budget is back in balance, that takes like $3 billion off the table. Those big blue surplus lines you saw on the prior page, just reduce them by $3 billion a year because we should be rebuilding our reserve. It doesn't allow for any cost of living adjustments, again, because that's what statute calls for. Now, again, Prop 98 is different because you have your own constitutional requirements. Those are built in. The forecast does not account for the repayment of many obligations Governor Brown likes to refer to as the wall of debt. We still have lots in both the education area and the non-education area where we need to pay off past special fund loans, mandate obligations, et cetera. So we still have a lot to get our budget back in order, and the budget does not account for all of those over the forecast period. We've talked about the revenue volatility and the Proposition 98 maintenance factor. The legislature adopted a proposal by the governor on the way that we would pay back the maintenance factor. It's a rather technical issue, but what it will do is add to the volatility in both Prop 98 spending and means more ups and downs. It has a good upside for Prop 98, but it also has a downside for the rest of the budget. And remember, our forecast period goes to the end of 2016-17. What happens the next year? Prop 30 tax increases start going off. And so by the end of that period, you would like to be in a situation where your budget is balanced, you have a reserve, and you've paid off these past obligations and budgetary debts that you've accumulated over the last 4 years. So we felt after giving them the good news that, wow, things are a lot better than they have been for the last 4 years. There's still a lot of work to be done. And I think, as we'll see in just a second, the news for Prop 98 is particularly good. The rest of the budget, maybe there's a lot more caution about what is possible, again, absent any additional revenues that the legislature would want to consider. There's not going to be a lot of room for growth. So it could be in this position where 98 is seeing good annual growth. The rest of the budget is pretty tight. And you can imagine what the pressures that will place on many of the members of the legislature. So let's, well, the next page is just really just shows you how those surpluses can drop if you were just to do two things. Make your reserve requirement, your payment into the reserve, and provide cost of living adjustments. And you can see the top line, the 3 lines down where you have operating surplus. Those were the ones, the numbers reflected in the chart of 2 pages ago, the big blue surplus bars. And then if you go to the bottom of the page, you can see that those are reduced substantially if you just do those 2 things. Surpluses at the end of the year goes from just over $9 billion all the way back down to 3.7, which is still good. I mean, this is still positive news, but just a few different assumptions and those numbers could look very, very different. Okay, now let's get to 98. This combines both the general fund forecast and property tax forecast. We have property taxes growing faster than the guarantee, so the general fund portion actually doesn't have to grow as fast. If you go down about 4 or 5 lines, the year-to-year change in the guarantee, this is really what I think is most important to you. And you can see after the big jump in 12-13 because of the passage of 30, you can see that the amount, the growth over the prior year tends to be in the $2 to $3 billion range every year. And that equates to a 4.5–5% on average growth a year. Now, that's even more powerful than it suggests because for K-12, which is obviously 90% of this guarantee, there is no enrollment growth over the period. actually declines a little bit. So you're not having to spend some of that money just to pay for new kids. It's available for either cost of living adjustments or for actual growth in program. So 2 to 3 billion, even after cost of living, you're talking about $1 billion, $1.5 billion in new program growth for the community colleges and the K-12 system. That's very good news compared with where we've been, obviously, in the last 4 years. There is also built into our current year base a $2 billion payment that was used to pay off deferrals. That's available in subsequent years. If we continue to use that $2 billion each year, we could pay down all of those deferrals over the forecast period. That would be a very good thing in my view. We should be paying schools for the cost in the year in which they are incurred. So in addition to these growth numbers, you do have an amount that's already built into the budget that could be used for, in effect, these one-time, annually, these payments that could lower your deferrals. That would be an excellent thing in my view. So overall, very good news. Now, again, remember, this is based on a forecast that's fairly stable. It assumes moderate growth over the entire period. It doesn't take into account jumps up that we've historically, realized in the past, or reductions, both of which are just as likely to occur at some point over the forecast period. On the last page, just a reminder about these one-time obligations. These are actually debts that we owe. This doesn't, I'm not talking about the maintenance factor or deficit factor. Those are also funding pressures, but they're not debts. They're not things you have to go back and pay off. What we would like to see paid off are things like the deferrals, education mandates that we owe both you and the schools, and an emergency repair program. It's a K-12 program. So these are like $13 billion in one-time payments that would be nice to make a huge dent in over the forecast period. So with that, Mr. Chairman, I'm happy to answer any questions that the board members might have.
Members? Member McDougall?
Yes, I wanted to ask on the first chart and the number of years that it takes to get back to the average. Do you have any analysis of the general conditions in California in terms of its viability, the industrial base, et cetera, that is affecting this either positively or negatively and might have an impact on the future?
Well, I think for California, we were obviously one of several states that were especially hard hit by the housing bubble and the drop in housing prices. And that's why, in large part, it's taken so long, as we're still working out of that. And prices have stabilized. They're starting to grow. And so there's no reason to think that the forecast return isn't very likely and possible. But if you're asking me, well, is there anything else fundamentally different about our ability to either go down in the future? I guess that would depend on what happens with housing prices. But maybe I'm not getting to your question.
But that's the only variable that, what I'm getting, you hear a lot about California being inhospitable to business, and businesses therefore moving out of the state. So I guess my question is oriented toward that consideration, and in your analysis, I would assume that big picture is examined. You did point out the importance of housing prices because it's been such a critical factor in California with the great increases that occurred over a few decades. And that is probably going to stabilize, and now we've suffered the worst of the adjustment. But is there anything else, or
Well, certainly there's a lot of concern about manufacturing in the state. Those numbers do not look good. We're a high-cost state. We have high land cost. We're a strong regulatory state. So if you're asking me, is this a state in which manufacturing is likely to do extremely well in the future, I would say, well, no. That doesn't mean, though, the state doesn't have strengths in other areas, professional and technical services, exports, clearly agriculture. So it may just be that we are morphing into a different type of state where manufacturing is not going to be perhaps one of our strengths, for the reasons that were mentioned, but that other areas hopefully will compensate. But I would look at housing as if prices are returning. If they go up too fast, if they reinflate and cause another bubble, that's what I would be more concerned about.
Yeah.
And you also need to kind of watch the stock market. If you have, another rapid rise in stock prices and other assets, that can just set you up for a fall again.
Right.
Because we just don't know when housing prices are going up, when the markets are going up, the financial markets are going up. We don't know what's ongoing and what's one time. We didn't, if you go back to that capital gains chart, when we were growing from 20 billion to 120 billion, we had no clue what was one time and what was ongoing.
Right.
And we probably should have been more cautious back then in the way we made commitments. And I would say to you the same thing would happen if you see the stock market going back up to 16,000 and housing prices are reinflating, getting back up to the peak that they were in the middle part of the decade. You should be cautious about the spending commitments that we're making because we won't be able to sustain those.
So following up on that question, I don't see property taxes reflected in this piece here on the general fund and education protection account. Is it embedded somewhere in those
On the
categories?
revenues?
On revenues.
Yeah, since it's not a state revenue, it wouldn't show up on that, but it is in effect captured on the expenditure side, in which
Okay.
we have to forecast property tax revenues because of the implications for school spending under Prop 98.
That's why I'm asking, yeah.
And so we do forecast it, but it's shown more indirectly.
Can you comment a little bit more specifically on what you would anticipate in terms of a trend line on
Yeah, I'm sorry,
property taxes?
I don't remember the exact numbers, but we've
No,
been.
no worries if you don't have the
We've
data.
been kind of flat almost on growth, and we expect it to start resuming, and I think it gets up to 5% a year in growth in assessed valuation towards the end of the period. That's still relatively low
Right.
by state standards, but and in fact, it may be a little bit more than that. But we've recovered. Did you have? Dan may have a number.
I was going to say, I think I recall from your forecast, you say about 6% over the time.
6%.
So we're moving from being rather flat back up to at least more historically normal levels.
Thank you.
Slow, steady growth is a good thing.
Oh, absolutely, and especially for the state budget.
In predicting how something like Prop 30 impacts on revenues, how confident, I think you responded to that with a manufacturing response, how confident are you in terms or in predicting the actual revenues?
Not
that
very
occur?
confident.
Not very confident.
When we give a forecast for general fund revenues, it's about $100 billion. It can easily be $4 billion up or down from that number. It may even be more. That confidence interval may even be greater than that now on a year-to-year basis because of the changes that we made to the tax code and because of what's happening at the federal level. The estimates on Prop 30, there's even more variability around them because it's all concentrated in the top 1% of taxpayers who have the most variability in their payments because they have the most control over them in the way that they recognize gains and realize gains, take income, and the actual fluctuation in their realization of income. And so these are rough ballpark estimates that can be wrong by
ballpark
billions.
estimates, but after time passes a year or so, you can reflect back and see the actual.
Yes,
and you
but
can define it.
yes, but again, it doesn't help you for the future.
Yeah,
We may have been spot on where we were on the revenues, and doesn't necessarily mean anything about the coming year's revenue estimates.
Vice President Mark?
First off, thank you so much for this report. It's very helpful, and I appreciate your analysis from a distance when I'm reading in the press. You're always a voice of reason on what's happening in the state, and so I appreciate the work you do. I have a couple of questions about the charts.
Sure.
The first one, though, which gives me a lot of anxiety, it looks like for the last 20 years and into the future, we may be almost in a state of permanent recession, except for the tech bubble. You know, if you go from 90 to 95, there was the tech bubble, and then from 2001 to 2005, and then there was a brief kind of, are we in a state of permanent recession, actually, in the state of California?
Well, that's a tough one. If you go back even the last 20 years, there have been very different causes for our downturns. In the early 90s, we had a complete collapse of the defense industry, right? we lost most of our defense industry in Southern California, and California had a much tougher time than the rest of the nation because of that. Then you had the dot-com bust, which was magnified certainly in California because, again, our reliance on personal income taxes. And then the recent recession has been something unlike what we've seen since the Great Depression. So it's kind of hard to know whether your answer is this signaling us historically that we're in for more boom and bust times,
Right, we're in a
shorter
realigning
cycles?
our whole economy down, and we'll see where the growth. And this is where I want to get to the point of where the community college system can fit in. But then also the next page, you've project out the general fund accounts, and there's some signs of encouragement. But just for perspective, where were we 4 years ago on the general fund revenues? So we're at 86 billion this past year. Where were we in 08, 09, or 07, 08?
We about 104 billion.
Yeah, so we're still significantly behind, and we don't get to those levels for another couple of years.
Right,
That's
although
the way
again, I think it's a valid point. That shows you again the depth of how much we fell. But remember, we've made other major changes in our fiscal structure. Realignment, in effect, took about $5-6 billion off the table. It's no longer counted as general fund that we shifted to counties. So
Okay.
it's hard to do apples to
Okay,
apples.
I see what you're
But the
saying.
point is still fair. It was incredibly deep recession, and particularly in California. And you're right, we don't get back up to there until probably the following year.
Right. And so then where I say, you've given us some good advice about to get throughout the system about managing our budgets in the coming years due to the fluctuations. But looking more globally statewide, where can the community college system from where you sit also help be that engine of economic growth in California with the kind of the collapse obviously of manufacturing and the defense industry and others? Have you taken a look, and do you see a role for the community colleges in helping maintain a more stable economic future for the state of California?
Well, yeah, I think that the community colleges have a crucial role, and I think actions that this board has taken and the legislature's taken on transfer and student success are excellent steps in the right direction. I think we haven't always focused our resources as wisely as we could, and I think some of the actions that you've taken are trying to do that to make sure that that students are prepared to take the classes for which they're signing up, that they know a pathway to get to where they want to get, that we offer the courses they need and the time that they want to take them. So I think some of the actions and the steps that you've gone down in recent years are crucial, in my view. And there's probably more that we can do. And so I think we need to keep having that discussion of how do we make sure that community colleges are taking care of kids that maybe didn't do what they should have done in their first years in school, but also that you're doing that transfer function, that you're doing that voc ed function. I think you have a crucial role. As far as the budget, though, I think it's a little bit different. It's almost a different answer.
Sure.
If you're asking, well, how do we ensure some sort of stability? Well, unfortunately, you've kind of hitched your ride to a very volatile wagon. That's called 98. And 98 is hitched to a very volatile revenue structure. So if you're asking me what can the board do as far as providing some stability.
I'm more thinking, though, we're going to certainly make the system more efficient, and we'll be able to manage the budgets accordingly. But our charge for the system is how do we make California's economy continue to grow? Are we providing the skilled training so that that we produce more laborers who are going to contribute to the economic growth of the state? But that's a broader issue that because I'd like to see these numbers continue to grow, even if Prop 30 is not renewed in such a way, so that the state's economy is growing, because that we're providing the labor needs of the businesses and other employers that will actually generate more revenue for the state of California. That's all.
Member Sumi?
I want to thank you very much, Mr. Legislative Analyst, for presenting the report. It was very informative. I just want to get a little bit more specific about, in terms of the economic modeling, you've mentioned that manufacturing isn't going to be the source of economic growth in the future for California, and you did mention some of these other potential areas. I mean, I mean, do those economic forecasts say that there's going to be growth in some of these, like agriculture or professional technical services? Is that what they're saying right now? And that's why we can, you know, there may be growth in revenue?
Well, again, we do forecast, and economic models do forecast by certain sectors. And again, I don't want to suggest manufacturing is still not important. It's
Right.
just that I think the prospects for growth are not as great as in the past. Clearly, one of the biggest strengths in the economy has been in like professional and technical services. And that includes, you know, our high-tech services. And yet I think across the board, we just need to make sure, and it gets to, I think, Mr. Mom's question about how do we just make sure that people have the skills they need to find jobs, that California is a good place to work, a good place for businesses to come. And if we're going to be a state, and I think we are, that values the quality of our resources, our environment, we are going to be a strong regulatory state. Relative to others, some employers are going to look at that as being a disadvantage. And to overcome those disadvantages of being both high land costs, high housing prices, large regulatory burdens on businesses, we need to make sure that we can have a skilled workforce that makes employers still want to be here. And that's why I think your question, Mr. Baum, I think, again, the community colleges have a crucial role, along with the universities, in making sure that we have the type of people that employers need and want. Because we are working, you know, kind of against the flow a little bit. Other states, especially Western states, have much lower tax burdens. Several have no income tax. They don't have the same type of regulatory pressures that employers will face in this state. So we need to make sure that we maintain those other advantages we have in addition to our climate and our physical resources, our people. We need to make sure they have the skills that employers need and want. And I think that's a crucial challenge for this body.
Any other comments? Okay, well, Mr. Taylor and Vice Chancellor, thank you very much for joining us this afternoon.
Thank you.
Dan,
Great job.
thanks a lot.
Thank you.